$100 billion just got wiped off the Treasuries market. Yields are up, interest rates are spiking, and it's happening as Trump, yes, the tariff guy, might actually be softening some of his trade war policies. So what's going on? Is the pressure starting to mount? Is the U.S. debt machine finally under real stress? Or is this just the new normal? Let's talk about it, calmly, clearly, and with a little honesty. If you're tired of the spin and ready for straight talks, subscribe to America's Geopolitics. Now let's break it down. We're going to start with the facts. Over the past few weeks, global investors, mostly foreign governments, have sold off about $100 billion in short-term U.S. Treasuries. That's a big-ass move, one that's rattled bond markets, pushed yields higher, and triggered another wave of concern about America's growing debt load. So is this the moment the world turns away from the dollar? No, not yet. This looks more like a portfolio rebalance than a vote of no confidence. China may need liquidity, Japan's defending the yen, others are simply adjusting to a world of higher interest rates. But it does raise a real question. How much more can the U.S. handle before this becomes a real problem? And this is where Trump enters the picture. Trump built his economic brand on tariffs, on bringing manufacturing back, confronting China, and rebuilding the American industrial base. But yesterday, something interesting happened. At a closed-door fundraiser, he reportedly walked back some of his more aggressive tariff language. Advisors close to him say he's open to adjustments if it starts to hurt American consumers or slows the economy too much. Is that a flip-flop? Well, it could be. Could he just be looking for a better choice? Man, it's hard to say at this point. The debt's rising, Treasury yields are climbing, inflation is stubborn, and even if you want to keep pressure on China, you still need room to maneuver. This may be Trump's first real signal that he's starting to listen more closely to his team, and he's looking for a strategic ground. Now, let's connect the dots. The U.S. has hit China with aggressive tariffs. China is facing deflation, capital flight, and a collapsing property market, and in response, China's been pulling out of U.S. assets, including Treasuries. That's not a coincidence, but it's also not an unraveling of the global dollar system. Here's the uncomfortable truth. Even if China sells Treasuries, the rest of the world still needs them. Europe can't offer scale, BRICS can't offer trust, and China, it's not even fully convertible. No one's replacing the dollar anytime soon. Still, if enough countries start offloading at once, the Fed might have to step in and buy more debt. And that's when inflation risk goes up. And so it becomes a balancing act. Not just for Trump, but for the entire American system. Here's the big takeaway. Yes, foreign governments dumped treasuries. Yes, yields spiked. And yes, Trump may be shifting a little on the tariffs. But the fundamentals haven't changed. The U.S. still has the deepest, most liquid capital markets in the world. The dollar remains the global reserve currency. And the U.S., for all its debt and dysfunction, still offers unmatched scale, transparency, and power. But there is a limit. Even a system as strong as America's can get stretched too far. So maybe, just maybe, this is Trump adjusting course. He's not abandoning tariffs, not giving up on reshoring, but softening just enough to keep the system stable. Because that's what real power looks like. You don't have to break things to win. You just have to outlast the competition. So what do you think? Is this a sign of smart strategy or signs of pressure building? Let me know in the comments, and while you're at it, hit that like button. If you really want us to support the channel, check out the links in the description below. This is Frank with America's Geopolitics. See you next time.